For now, I'm telling you what the bear case is, and it's actually happening today. We are experiencing the worst part of the bear case, in my opinion, which is the economy hangs in there.
This is all headed to yield curve control, which means $1 million Bitcoin.
Like the market's going to rally and rally tremendously when the Fed pauses, probably sometime end of Q4, middle of Q1. I think that's kind of, you should expect the market to bottom and rally from that point. But we're probably going to puke again at some point in 2023.
This is, without a doubt, one of the most challenging moments in the entire global economy. But today we have one of the leading experts in the entire world on not just understanding what's going on, but actually investing in this insane climate. Please welcome Darius Dale to the channel. We did an infamous interview back in January where he predicted almost everything that's happened this year. You absolutely must watch this interview front to back. And if you're excited, smash that like button. Make sure to subscribe, as we're going to be bringing on experts like Darius to help you understand the insane, rapidly changing economy that we find ourselves in. Welcome back to the channel, Mr. Darius Dale. Now, if you guys haven't seen this episode, we recorded a video in January. I had absolutely no facial hair. Darius told me, if I'm right, you cannot shave, and here we are. So that tells you about everything you need to know. Throughout 2022, Darius has called almost every single move of the market. He's either got a crystal ball or something else we need to know about, but either way, you absolutely must pay attention to the information we're about to go over. Thank you so much for joining us, Mr. Dale.
Elliot, man, that is such a kind introduction. I really appreciate you, man. We haven't gotten everything right, but we've gotten more than most, I guess. So I guess we're riding high, and we appreciate that. You know, it's all just part of the process.
So first of all, definitely go back. We'll link the first video from January, which now feels like about 20 years ago, in the description of this video. But let's just get right into it. You've been calling since really November this complete pivot in the market. Most people shrugged it off, said, you know, boomer doomer stuff, right? And not so much anymore, right? Not so much boomer doomer stuff anymore. It seems to have become a reality. Can you tell us just a little bit of the story since, you know, the beginning of this bear market, and so we can kind of catch up to today and then figure out what happens next?
Yeah, absolutely. So I think it's easier to kind of explain this whole thing in phases, and sort of what we saw as phase one of this whole situation, which started back in November for us, as you mentioned, which is, look, inflation is running well north of the target. It's building momentum in a way that will suggest we're probably going to have some very adverse consequences on the reported inflation front. So phase one was the market moving ahead of the Fed, you know, let's call it from November through March of this year, into sort of pricing in the tighter policy path that the Fed ultimately had to enact. Phase two of this sort of bear market was sort of, let's call it, from the lows of June through the highs of mid-August, which is where the market sort of said, hey, look, the Fed is going to cause a recession. And the thing we know about this Jay Powell Fed is that it likes to pivot. You know, this Jay Powell Fed has proven itself to be quite dovish in bear markets past, at least. And so the market sort of took that pivot narrative and really ran with it throughout the summer months. Phase three, which is something we outlined and said, hey, look, based on our analysis of the core inflation data and just the sheer fact that we're passing the baton from headline inflation to core, would seem to suggest that there's going to be a phase three. And phase three was the Fed pushing back on, you know, sort of this expectation that they would be easy at any point in the near future, which obviously was culminated at Powell's commentary in Jackson Hole, which is part of the reason we had such a negative September. We could skip phase four. Phase four is sort of the fiscal response to all this. I think UK is a great example of what happens when you do phase four wrong in terms of trying to introduce more fiscal policy. But now we're in phase five, in my opinion. And phase five is sort of, you know, I wouldn't necessarily say it's the hardest part of the market to manage, but history has shown, if you look at bear markets and you sequence them through, you know, the kind of different quartiles or different deciles, you typically have more volatility towards the end of the bear markets. And so that's why phase five is so hard. And phase five is acceptance. It's you, me, and everybody else who's listening and tuning in has to accept the fact that there will be no damn Fed pivot until all hell breaks loose. and all hell has to break loose before we get the pivot.
Well, it's funny you say that because obviously we both have been following a character on Twitter called Wifey, and he calls
Yeah,
he doesn't do phase 5, he does 4 phases, and one of them is Hades, which we haven't been to yet. So there's definitely an element of grief here and grieving and accepting what's going on. What do you think has been the most shocking part of this year for you? And has this been worse than you thought it was going to be, or is this about what you expected when this whole thing kicked off?
I don't know. I don't know if I had an expectation for the path. I've done this long enough now to not expect too much certainty. We sort of have a general idea of what the destination is, which is we got to get policy rates well above what we thought neutral was. We got to get the S&P down to a level that sort of accounts for that, in terms of the tightening of financial conditions and the widening of interest rates and what that means for valuations, et cetera. Did I predict every wiggle, ex ante in January or going back to November? Of course not. I mean, I think that's the stuff of fortune tellers and tarot card readers, not financial analysts like myself. But in terms of the thing that's been most surprising, I would say this year, is sort of how much people have gotten, I wouldn't say run over, because I don't want to say that make this sound like a trite comment, but a lot of this stuff has been very much on the tape since, at the bare minimum, March. I would argue clearly it was November to 42 macro subscribers, but at the minimum March, and people are still finding ways to lose tons of money. And I think it goes, and you and I could talk about this, I think it goes to the sort of the record animal spirits that we had going into this bear market.
Yeah.
People keep trying to buy the dip at every interval, and every interval we keep having these rallies, and ultimately we break giveaway to new lows, and that's been the case all year.
Yeah, it's funny. At least in the crypto sector, we're used to animalistic spirits, and so to like break that down, really, what I sort of fundamentally view from a very simplistic lens, the bear market's purpose is to just take the degeneracy out of the market and say, you know what, you can't just chuck money at random stuff and sit back and get rich anymore. And then the belief that you can do that, which is, if you're not doing that during the bull market, you're missing out, right? And if you are doing that in the bear market, you're like a lamb to the slaughter. The reality, though, is that we've seen and I remember this in 2018 when crypto crashed, my first bear cycle. Every pump, I was on the edge of my seat. Every news article about, Apple or, Google or anything, I was like, this is it. This is it. And I remembered that like my spirits got crushed over and over again. And then by the time literally I let go of the idea that there might ever be even another bull run, that's when it happened. And so there was something like very like almost like symbolic and metaphoric about letting it go and just almost believing it couldn't happen. And I swore I would sell everything when I uttered the words, I don't think there's going to be another bear market. And I said those words in Q4 of 2021. I was like, I don't know if there's going to be another bear market, and I should have known when that came out of my mouth that was the sign, right? Because there's just an element of these animalistic spirits, right? Of you need to, like, that's what this bear market's all about. So on the whole, we haven't still seen that yet. And I made a video about how retail continue to aggressively buy the dip in stocks. Where do you think is the tools we can use to really understand where we are in the bear market? Like, what tools do you use?
Yeah, so data. So I'll start by saying that every month, and I probably sound like a reasonably educated guy on Twitter and on podcasts, et cetera. That's not because I'm reasonably educated, I am, but it's more because we're doing the work on a regular basis. Every month, I put out a slide deck that's anywhere between 125 and 150 slides of fundamental analysis that tells me where we are in the economic cycle, where we are in the liquidity cycle, and as a function of those two variables, where we're likely to be in the market cycle. And this is sort of why we have these views in terms of where we are with phase 5, et cetera, et cetera. In terms of the tools you need, it's data. It's as simple as this. I mean, like, you think about like one thing that sort of has me up at night as a sort of longer term investor, someone who's very bullish on Bitcoin long term, is the fact that when I look at, sort of like, for instance, and there's another range of different things we can look at, but let's just focus on household sector balance sheet, right? If you look at the household sector's balance sheet, their current level of equity shares and equity ownership, I'd use equities as a proxy for risk assets, as a total share of overall net worth, or not net worth, overall assets, is somewhere around 31%. Now, we came off of all-time high of 36% in the middle of last year, but 31% compares to like 20s, lows, high teens, mid-teens in terms of the troughs of previous bear markets. And so that scares the living daylights out of me as a longer term bull on something like Bitcoin or a long term bull on America. Like where is the ultimate lows once we have to rinse all that excess animal spirit, all that excess speculative risk taking out of the system? I don't know.
So I guess what I'd say is one of the things that I've been attuned to, and we can just touch on this quickly because we have so much more important stuff to cover, but like there's been a rise of investing as like a culture, right? As a pop culture, right? And this has not, and this was part of the pandemic, this was part of a lot of things, but like, Robinhood topping the App Store, Coinbase topping the App Store, Wall Street Bets. You have, you go to Netflix homepage right now, there's a documentary on how to invest passively. Like the concept of asset allocation now has become for everyone. Channels like this have played a role in that, right? We've all, like there are examples of people allocating small amounts of assets and greatly improving their wealth. And so now the keys are out there. And is this something where like the game is changing because too many people are playing it? Or is this something where now there's more and more people who will just be holding? And so that trough number you were talking about of 18% or whatever on the last bear market, that's maybe not relevant because we now have, 50 times or 20 times as much like participation in the markets and understanding of the markets.
Yes and no. So the game is changing. You made a couple comments that I think are worth unpacking really quick. So the game is changing. Everything that I can see just from doing this for nearly 14 years now, everything happens faster. Things get priced in faster. Trade opportunities get eviscerate faster. Like, you trade moves faster when you see an opportunity in the market from a tactical standpoint. Everything is happening much faster. One, the machines, the robots, the proliferation of all the technologies is facilitating that on the buy side. But secondarily, information flow is faster than ever. You used to not know what the 3-month annualized rate of change of median CPI was until someone put out a note later. Now you know almost instantaneously now, and that kind of stuff can move the market. So things are happening faster. But just in terms of the overall sort of speculative risk taking, we've seen bull and bear mania cycles. I mean, you go back to the 2000s. I would argue this crypto cycle was probably a little bit like that on steroids, just given the Fed, the liquidity cycle fundamentals that really contributed to that bull mania. But this isn't the first bull mania we've seen. We saw bull mania going back into the 2020s. But just on the one final comment on the balance sheet composition analysis, the reason we look at things on a ratio basis is not necessarily to say, well, it's the bound of the properties. It's to understand that, hey, look, you can't go beyond 100, you can't go to 0. And, these things tend to be cyclical. And so I'm not saying that we have to go back to the low 20s, high teens in terms of equity ownership as a percent of household balance sheet. But I can tell you that 31 is still north of any other prior peak. Mm-hmm. So we got a long way to go to get down.
Yeah, that's really interesting. And I think it's time that we move on to the meat of the conversation today. So that was the warm up. I hope you all are ready because now we're going to jump into the really important stuff. What happened yesterday? What happened?
Oh, absolutely. Yesterday was an excellent opportunity. So what happened yesterday, clearly the CPI and inflation data really sort of came in and from an adverse perspective. If you look at things like different measures of core inflation on a 3-month annualized basis, which is the most important measure to track. Not only Jay Powell said that, but that's clearly the leading indicator for the year-over-year statistics. We had things like median CPI coming in at 6%, 7%, sticky CPI 6-7%. Services, we all know shelter's going to keep raising. I think that's like the worst kept secret on Wall Street at this point. But
repeat that again. Is shelter's going to keep?
Shelter inflation is likely to keep accelerating, partially because of the way the BLS calculates services inflation. It's on a severe lag relative to observed changes in rents, observed changes in house prices. Partially fundamental, partially technical. Fundamental. I know this is diatribe, but I'll explain this because I'm sure people want to know about this. Fundamentally speaking, clearly when prices rise a lot in the housing market, you price people out of the housing market and they go into the rental market. So there's a supply and demand imbalance there. But technically speaking, the price appreciation that we're observing in the housing market or even observing in rents in real time doesn't get reflected across all of our rents at the same time. Like we all have leases if you're renting. And so, your rent lease might be up in January, someone's might be up in February. So what the BLS is attempting to do with that methodology is smooth it nationally across the country. Based on seasonal patterns with people renew their rents and stuff. So that's partially why it's such a lagged indicator. But we can't just say that it didn't happen because when your rent is up in 6 months, you will feel that inflation.
Yep.
And so you can't just say that inflation is gone, even though you're going to feel it. So that's why that's the case.
So short story, rents have peaked more recently, and even though they might be going down slightly in the near future, the indicators are just catching up.
The indicator is catching up to reflect the fact that some large portion of Americans have not even experienced the increase yet, even though it's in the pipeline. So that's what I'm trying to say.
So inflation numbers should still keep going up, even if things start crashing in the energy sector and other sectors. The rent sector
is crashing. Energy inflation CPI is down 40% 3-month annualized. So like it's already crashing and it's already being reflected in statistics. Now the issue is two issues. One, core services inflation, which is all the stuff that I'm talking about. Median CPI, sticky CPI, et cetera. All those things are still tracking at around 7% annualized, not year over year. Annualized, month over month, 3-month over 3-month annualized. The problem with inflation over the very near term is that oil has collapsed. And I just mentioned it's down 40% 3-month annualized. What if it doesn't collapse anymore? What if on the other side of the SPR release, oil either forms a bottom and stops going down or starts to rise again? We have China potentially coming out of zero COVID, Q4, Q1 of next year. Who knows? I don't know. But the answer is we're not done with this inflation fight. And so therefore expectations for the terminal Fed funds rate, et cetera, are not necessarily where they need to be before investors should be stepping in to buy risk.
Yeah. So when we first talked about this whole situation kicking off, and I'm fascinated, I'm really fascinated with the oil dynamics, the energy dynamics around the world, debt dynamics, all these things are fascinating in and of themselves. And they're all, what's really kind of, I guess, anxiety inducing is they're all happening at the same time. Maybe this is to be expected, right? Maybe this is part of what happens when when you get like a federal response like this. When we first met in January, I said, I'm going to tell my kids that this was the Super Bowl in reference to like an FOMC meeting or something like that. And your response was, I think that's a preseason game. And that has certainly played out. So what would I guess like what people on this channel will want to know is like, where are we? And it feels as though what we really wanted, and what we've talked about is what we really want is just to crash brutally, have everything break, demand get crushed, inflation get crushed, and then we could sort of start the road to recovery. That's not what happened. What do you think? Where are we in the season? And if this is a football season, a 16-week season with the postseason, how many weeks in are we with the Fed? And is it even possible to calculate right now?
Yes, I think it's possible to calculate because they've given us guide. So there's two things you need to solve for in that to answer that question accurately. One, where will the economy be on some medium to longer term time horizon? When I say medium to long term, I'm talking from the perspective of risk management. Risk management is typically done under a calendar year, usually within 1 to 3 quarters, in terms of how like the buy side thinks about putting in structuring trades. You also need to understand what the Fed's reaction function is. What outcomes are they trying to enact in the economy and in financial markets, and what would they consider to be an appropriate outcome effectively. So one, we know inflation is going to come down. It's written in the wall from a base effect perspective. The issue with inflation coming down is that it's going to likely settle, at least based on everything we know today and then leading indicators of inflation, it's probably going to settle at a level that's very unpalatable later in this process. But the Fed has already signaled that they're not necessarily waiting for inflation to get to their threshold to stop. They're going to stop before gets to the threshold once they receive clear and convincing or clear and confirming evidence. Powell's used that a couple times, that it's slowing down. So you have to make some reasonable assessments on what does that actually mean? What does clear and convincing evidence that inflation slowing down means? It's our belief that we need to see 3-month annualized rates of change on things like trim mean CPI, median CPI, sticky CPI, all these measures of inflation that sort of get rid of all the noise, like used car fares and airplane tickets going up or down a lot in 1 month, all the stuff that sort of truncates the noise and gives you a very clean read on inflation. All that stuff's still tracking at somewhere between 6, 7, or 8% on an annualized basis. Those numbers need to get down to 3 to 4. And once they get down to 3 to 4, we might see a Fed that's comfortable, saying, okay, I've done enough damage. Let me pause. Let me assess the damage to the economy. I might do more damage, but I'm not going to do any more damage over the near term. That's what the viewers on this channel and really everybody in global financial markets is waiting to see. The problem with there's a couple of problems with that. The main problem with that is inflation momentum is still building at a very rapid pace. And so we keep having to push that thing forward in time with this sort of concept of the pivot. Where are we headed from a price perspective? I think that's an easier question to answer than the in ultimate sort of timing. I think it's easier to answer where we're going in price than it is when we get to that price, like when on the calendar. And the reason I say that, it's been pretty clear that this is something you and I've talked about on Twitter. Net liquidity has been the key driver of asset markets. And it has been the key driver of asset markets my entire career. But I would argue more, especially in the last kind of few years, because the part of the run up we saw in crypto and in stocks and everything, in 2020, 2021 was really driven by the rapid expansion in net liquidity, primarily driven by the Fed balance sheet expansion and massive decline in the Treasury General account from the 2020 highs. And now we're doing that in reverse, basically. And we run models that sort of forecast the direction of net liquidity. And for those who are new to that framework, net liquidity is the Fed's balance sheet minus the Treasury General account balance minus the reverse repo facility balance, two things that drain liquidity when they rise. And so we make estimates on the forecast for that indicator. We're effectively saying, hey, right around the year end, we're probably going to be somewhere close to 3,200 on the S&P. We're probably going to be somewhere around 15,000 on Bitcoin, at least according to our estimates of the changes in net liquidity. Now, if we're still in this phase 3-ish, Fed saying we're going to do more, phase 5 we got to accept by year end, that just extends the duration with which net liquidity is likely to continue declining. And so, where could we be by March 31st of next year? Probably 33,000 or 2,900 on the S&P, 13.5 on Bitcoin. This is how you get. It's the time that's the hardest thing to solve for at this particular juncture. But we know what price will be based on different intervals of time. It's just when do they signal we're all done?
Yeah, it's quite interesting. So I guess 13 was a number that's been in my head just since the beginning. I said that was my number when I played sports, and I just figured there would be a wick down, below that, right? And so if that's where it settles, we all know that crypto can overtrade itself. And I guess what I'd say is, first of all, net liquidity, that's just like the key, right? If you were to like simplify it all down to understanding what's going on, it's how much money's out there, right? Like how much money is there? And if there's money out there, it's almost like, sand in a bucket. Where does it all settle? Because it'll eventually kind of shake out roughly into all the corners, right?
Yeah, 100%. It's really a measure of how much balance sheet capacity is out there. Is the Fed making it easier for us as private sector actors to go further out on the risk curve, or is the Fed sucking us back in on the risk curve because it's leaving kind of assets that are higher up the capital structure like U.S. Treasury bonds for sale? It's basically that's really what's happening here. And so by that line continuing to drain, by that function continuing to drain, it's effectively forcing us out of our crypto positions and out of our meme stock positions and into the Treasury market. At some price. The Treasury market is still looking for an appropriate price to really get investors excited on the long side. And obviously, we haven't really found that yet. Some people think it's 4, and we've tipped 4 on the 10-year, tipped 4 on the 30-year a couple of times. But I have a view that it's probably going much higher than that. I think we settle up probably around 4 or 5 on the long end, maybe even close to 5 on the short end.
Yeah, I mean, so I guess this leads naturally into the next question, which is like, what is the worst case scenario? I guess like not worst case scenario. We all know worst case scenario can be dramatic, but what is like the realistic worst case scenario, not on the edge of the tail of disaster, but like what could this lead to? And then, what are the implications of, this not going the way the Fed wants it to go, but effectively them kind of losing control of the horse here?
Yeah, no, I'm going to read it directly from our October scouting report. So our bear case scenario, which is our modal outcome, it's our highest probability scenario, as we try to allocate assets across the assessment of the probabilities of 3 different scenarios: base case, bear case, and bull case. Bear case is the disinflation process proves to be sticky and stochastic, and that means it's high, it's going to stay high, and instead of just going straight down like a rocket or whatever the opposite of rocket is, a rocket with no fuel.
A SpaceX rocket.
SpaceX. Anyway, and instead of going straight down, it bounces down. It's it's going to take a long time basically to get back to the Fed's target, rather than accelerated and autocorrelated, which was what I think the market was hoping for, which is it goes down really fast and it's autocorrelated. It just feeds on itself and we're back to 2 over a really short period of time. And that is our bear case. It has been our bear case for an extended period of time. And it's our highest probability outcome. And I say the reason it's our highest probability outcome is because the dang economy is still too resilient. No one talks about this. It's the number one thing that we see in all our data at 42 Macro that is just completely absent from the consensus discussion. If you look at measures of GDP, and again, these are current economics, coincident economic statistics, clearly leading indicators. If you look at financial market oriented style leading indicators are telling you the economy is going to be in a much worse place on a kind of 12 to 18 month forward time horizon. But for now, I'm telling you what the bear case is, and it's actually happening today. We are experiencing the worst part of the bear case, in my opinion, which is the economy hangs in there. Because the economy hanging in there keeps core inflation hanging in there. We just got the consumer spending retail sales data today, and it was a slowdown. But if you look at it on a 3-month annualized basis, core retail sales, which feeds directly into GDP, is still at 3.8% on a 3-month annualized basis. That's still 50 basis points faster than it trended at pre-COVID. We are still growing above trend in core retail sales 9 months into a bear market and in a month where we had a major hurricane touch down in the U.S. Think about that. Think about how strong the economy is. And Elliot, you want to know why the economy is so strong?
I would love to know, yeah.
Nobody knows this.
Can I guess?
Yeah, go ahead, guess. Give me
Is it credit card debt?
Nope, it's the exact opposite of credit card debt. It's cash balances. People are sitting flush with cash like they've never been. You got to go back to the 1950s to see the share of consumer assets in cash as they are today. We have $4.9 trillion in checking accounts right now versus $1.2 trillion prior to COVID. We have $2.7 trillion in money market funds. We as humans, as the household sector. These numbers add up to right around 5% of overall total household assets. We haven't been at 5% since the mid-1950s. People are flush with cash. Corporations are flush with cash.
Isn't that a good thing?
It's a great thing. This is why the labor market is so strong. This is why consumer spending is hanging in there. We're still growing consumer spending on a real basis. It's up 0.9% on a 3-month annualized basis. Now, that's not a great number, but think about how much inflation we have. Like, we're still growing unit volume in a very high inflation volume market because in a very high inflation economy because consumers and corporations are flush with cash. Mm-hmm. And that's causing this process to be more elongated. I said in Macro Voices in June, the title of the episode, and a recession is the bull case, mm-hmm. because a recession causes the Fed to pivot, mm-hmm. and a recession allows us to start speculating on assets and net liquidity expansion again. Mm-hmm. We are getting further away from that outcome, mm-hmm. because the economy is hanging in there for longer than anyone expected.
So if we have so much cash on the sidelines and the economy is so strong and we have, on average, people having enough cash to deal with this, or in theory on paper, as across the nation, then doesn't that mean that effectively the inflation is just what it should be, right? Because we printed so much money. Like, there's just no way to slice it except when you print that much more money, the stuff is going to be worth less money, right? Or it's going to be worth more cash. Like, your cash is just going to buy less. So doesn't that mean that we just effectively need a repricing of everything with this more money in the economy? We need a repricing of jobs, right? The person who is serving coffee, the person who is crunching spreadsheets, the person who is your chauffeur, all those people need to be paid differently because the economy's just shifted. There's more cash. People have more cash. And thus, the inflation is not something we can run away from. There's nothing we can do to stop it. It's the meteor hitting the earth, right?
Well, so that's a lot of stuff. I agree with everything you said. I think it's important to unpack several aspects. So yes, you and I are going to get hate mail for this because there is a camp out there that says inflation is supply side driven. It's crude price shocks, energy or agricultural price shocks. There's supply chain shocks. There's all these supply side forces that have caused inflation to go higher. And you can see this just based on the deviation from trend across core inflation statistics across the whole world. Everyone's having a high inflation problem right now. The issue with the U.S. specifically is that we had a demand shock on top of a supply shock. And that's where I see there's been a very real disingenuous nature to the debate around inflation out there and on FinTwit, et cetera. Around this concept. We threw $7 trillion into our economy from the fiscal authority on an economy that, at the time we threw the money in was $15 trillion. That money is now sitting in everyone's checking account It's sitting in money market funds. It's sitting on corporate treasurer accounts. And guess what? It's in the CPI statistic, and it's going to stay in the CPI statistic.
You essentially had a 50% in inflation in the money supply, so that needs to catch up.
Did. I think the money supply year-over-year growth rate peaked somewhere around 40 or 50%. You're absolutely right.
So shouldn't, I mean, in theory, right? If inflation is about how much cash versus how much stuff, the stuff didn't go up 50%, the cash did.
Yeah.
So you know, like.
It's not that simple.
No, of course, but like like if I was to explain this to a 5-year-old, you know,
you're correct. Yes.
Right, and I get it. There's all these.
To a 35-year-old economist, you'd be in the room for 2 hours.
Of course. But anyway, so here we are, right? And so what really happens next? And like, obviously, you know, my channel is very fixated on what happens to Bitcoin. I'm a big believer that buried in all of this, between, you know, tensions between East and West, you know, the disappearance of jobs, the digitization of our online culture, the rise, particularly for me, of like video games and that is online culture, like all of it kind of pushes us towards digital assets as a new thing. That even if the economy is flat, in my opinion, digital assets continue to make growth and kind of eat away at other sectors. That's my personal belief. And it sort of feels like there's a lot of bull cases for Bitcoin in there, even if the economy doesn't have this like wild bullishness. In fact, it's probably better that it's not just like, you know, dog coins and stuff like that, but actual real usage of these products and services and protocols. Like, what can we expect? And like, are there opportunities in this world for, you know, things like digital assets or risk assets to make growth? Obviously, real estate probably has a long way down, but like, what about these alternative pockets of the economy? Can you see them having any success in this environment, or is it just about, you know, staying on the sidelines?
In this environment, like next 3, 6, 9 months, no. I mean, it's that we are on the wrong side of the cycle. There's a lot of excess liquidity that flowed into those areas of the economy through VC, et cetera, that is just dead money. And we need to just roll through the cycle to figure out who's a legit survivor or not. So like, you know, it's still, I think we're still too early in the bear market, still too early in the down cycle for a lot of those activities to assess whether or not we should be, you know, going in. I think most people would sit on their hands. Longer term, I think we are in I don't want to sound facetious, but like, there is no maximum price for Bitcoin in the outline that I have. And the reason I say this is because we've done a tremendous amount of work. We built a very sophisticated dynamic factor model that tries to project the longer run trend of core inflation. And I anchor the model on core PC because that's what the Fed cares about. And the kind of the key takeaway in the model, and there's 16 different factors. It looks at things like deglobalization, changes, the compositional shift in the labor market, things, you know, to the big changes in wages, et cetera. All these different major factors that have contributed to disinflation over the last 35 to 40 years are now, many of which are now contributing to a rise in the trend. And so the rise in the trend is somewhere on the order of magnitude of about, on the high end of the estimate projection range, about double where it trended in the pre-COVID era, right around just shy of 3%. Well, that doesn't sound like a lot, but when you have a Federal Reserve who's trying to get you to 2, and it won't, and the model, the economy is saying 3 is the minimum, we got a problem, right? There's 100 basis points that we have to reconcile as investors and policymakers. And it's my belief, based on reading the tea leaves from August of 2020, when they sort of adopted, they put the revision into their average inflation targeting framework, or they introduced it, and they introduced the maximum and inclusive employment. You know, this is where the concept of the woke Fed came from. I think this is an increasingly woke Fed if you look at some of the appointees that the Biden administration has landed on the board. I think this woke Fed is headed towards a positive revision to its 2% inflation target at some point in the next 1 to 2 years. And when we get
meaning
to that
they
point,
accept 3%.
It's the 3 is the new 2.
3 is the new 2.
Yep. The new 2. 3 will be the new 2. If you remember anything, everyone, from this interview, there's a couple things you remember, but that'll be one of those key takeaways, which is 3 is the new 2. And in a world where 3 is the new 2, there's no freaking reason we all need to be running, not we, because we don't believe in that, but we all as the general public need to be running around with a 60-40 portfolio. Why in the hell do you need to own 40% of your assets in bonds if the Fed is telling you that it wants 50% more inflation on average? You don't. You don't. You shouldn't.
Well, unless those bonds are priced at 8% or something like that, you know, and then you end up with just so much more yield on it, right?
So let me finish. So the ball bouncing ball. The yields are going to get to unpalatable levels, perhaps more than likely because we're flowing assets out of the fixed income market and into things like equities and Bitcoin. And that's obviously positive for equities and Bitcoin at the margin, although I'm not so sure that it's necessarily that positive absolute, because again, you have capital destruction in the whole world in that scenario. What I think will be the most positive dynamic is not the positive revision that catalyzes the flows out of the fixed income market and then into the equity and credit markets. It's going to be the financial repression to cut off the top of the yields. The Fed's going
The
to say,
yield curve control.
yeah, something that looks like yield curve control, or it could come through regulation. The Basel III basically created a massive need for treasuries, treasury bonds on bank balance sheets and on insurer and pension fund balance sheets, et cetera. So they can change regulation to force us to need more of these securities. But the reality is, I think we're headed for a world of more inflation that causes outflows from fixed income into assets like Bitcoin, which is why I say it has no roof. The price has no roof in this scenario because there's way more bonds outstanding than there is supply of Bitcoin, and increasingly that will be the case. If you look at the fiscal policy projections, and in that world, those outflows are going to get supercharged by the fact that the Fed's going to effectively cap yields and force things like banks and insurance and pension funds to maintain their allocations to these assets. So I think that's where we're headed by the end of this decade, and I think that process is likely to commence at some point over the next, let's call it 18 to 24 months.
Yeah, I mean, so there's a character in crypto land. His name is Arthur Hayes, and he is, he started a sort of notorious leverage trade, the first Bitcoin leverage trading exchange called BitMEX, and he put out some really compelling work on the concept that this was back, I think, in February or March. He was like, this is all headed to yield curve control, which means $1 million Bitcoin. And so I feel like that's kind of what you're not putting a price on it. You're saying, hey, look, there's no upward bound in a world of yield curve control because assets effectively will be, you have fixed asset like Bitcoin. There's no reason why it can't keep appreciating in a world where they're banning higher yields and they're banning inflation, which means effectively they're just going to print money endlessly, right?
I'll send you a chart after this for the video presentation of this discussion, but pull up a chart of the Nikkei this year in Japanese yen.
Yeah,
you would have no idea there was a bear market globally.
Yeah,
and I think that's where we're headed. I think it's because the inflation that we're not going to be able. There's a political choice the Fed has to make, right? It's not going to be easy. So it's going to be easy to get inflation from 9 to 3, 4, 3. But how do you go from 3 to 2? 3 to 2, you can go from the unemployment rate going up by 50 to 60, 70 basis points or whatever they're forecasting for the end of next year. It's specifically 90. I know that off the top of my head. I'm sorry. I like to be specific. It's 90 basis points. That'll get you to, let's call it 3% inflation. But what if they try to go from 3 to 2, you're going to have to go from, up 90 basis points in the unemployment rate to up like 300 or 400. And that's a political, Biden's not going to have that, particularly, if you think about, it'll be election season in 2020, it'll be 2023. They'll start talking about 2024 and, they're not going to be able to do that. And so I very much agree with the BitMEX guy in terms of his view on this is where it's all headed. The process of getting there has got multiple steps, which is where I think, firms like myself, folks who are on the institutional side of things, who are more tasked with risk management in terms of how do I make money along the way? There's going to be a lot of steps in there, but I think we agree on the destination. It's the steps. When you see me tweet this out, respect the x-axis.
I constantly drop that under people's tweets because it's a really nice thing to say, and everyone. Yeah. Well, I know my reaction when I saw that is like, "What is the x-axis?" I never thought about that one. But then you're like, "Oh, it's time." So because I want people to really have a solid understanding. You've talked about so many things. You're so sophisticated. Simply, what are the things we should be looking at? And effectively, it all leads to them controlling yields, right? It all leads to them effectively manipulating the bond market so that those yields don't go up. What are the few things that the audience should be looking at to really understand how this is all moving? And why does controlling yields effectively send the stock market and Bitcoin and all those things upward?
Yeah, so I'll give you sort of a roadmap on kind of how I expect this ex ante. And again, it's mid-October 2022. We're getting new economic and financial market data every day. Our models update every day. I think we have some of the more sophisticated nowcasts that, I've seen certainly on publishing research. Obviously, people on the buy side with much better tools, but so everything I'm saying in terms of my current estimation of this path, you have to take it with a grain of salt, or more or less. And then what I mean by grain of salt is check back with me on regular intervals to make sure that the models haven't updated and they're saying something different. I think we're probably headed for a situation that the Fed effectively is going to be dared by the resiliency of the economy to break the economy. The Fed will break the economy. In the process of breaking the economy, we're going to get inflation down to a reasonable threshold that looks like they might be able to take their foot off the gas. They might be able to supply liquidity. They're not going to supply liquidity because the Fed, this is a Federal Reserve that is very keen on, I guess, legacy, if you will. They're really concerned about their legacy, the Arthur Burns, et cetera, et cetera. And my friend Jim Carson has a different take on that, but I respectfully disagree. Jay Powell doesn't want to be remembered as Arthur Burns, however hawkish or not hawkish he was actually in real life. Because of that dynamic, I don't think the reaction function to supply QE and cut interest rates is going to be there when the economy needs it and when the markets need it. And so we might have a more adverse scenario in markets and in the economy, like a double dip almost. Like the market's going to rally tremendously when the Fed pauses, probably sometime end of Q4, middle of Q1. I think that's kind of, you should expect the market to bottom and rally from that point. But we're probably going to puke again at some point in 2023 because the Fed's not going to come out and expand its balance sheet. Is not going to allow the net liquidity function to really get going in a really material, sustained manner. It's at that moment where the Fed has to do the aha moment, like, oh no, we're really not going to get 2% inflation. We really do need to revise our inflation target. Otherwise, this is going to get out of hand. Who knows when that happens? Is that a late 2023 event or a 2024 event? I have no idea. But my point is, it's in that aha moment where you start to see the flows permanently leave the fixed income asset class, permanently rotate into the equity space, into alternatives, hedge funds, physical and digital commodities like Bitcoin, et cetera, gold, et cetera. And from that point, you're going to have a pretty sustained, serious bull market in that stuff. And I think that bull market is going to be twofold, like the point we made earlier. It's going to be, one, the flows out of fixed income. But more importantly, it's because smart folks like me, I've been thinking about this for 18 months now, and you said the guy at Big Mets has obviously authored a similar view. The smart folks are going to realize the Fed is not going to sit around, the Treasury is not going to sit around and just allow interest rates and a mass exodus from that market. Eventually, they're going to cap yields somehow. It might not be yield curve control with the Fed's balance sheet. Again, there's regulatory tools they can use to force you into the Treasury market as well.
Got it. Okay, so by controlling yields, they could force people into the Treasury market. But how does that? Let's just say
regulation.
Yeah. How does that pump our bags, sir? How does that send my Bitcoin? Like, how does that pump my Dogecoin up? Like, how does that work? Because I feel like there is a connection, obviously, between them controlling the bond market, which everyone, welcome to 2022, where you had to look up what a bond is, and to a whole new generation. How does that work? Like, how does that money flow in, the simplest terms?
Yeah. So the simplest terms. The U.S. government is at the very top of the global, domestic and global international capital structure. What I mean by capital structure is ways in which people who have savings can transfer their savings to people who need the savings to invest and get a return for it. And so that asset being at the top of the capital structure, when it issues new supply, it tends to crowd out other assets unless you have an extra governmental agency like the Federal Reserve, flexing its balance sheet to absorb that asset. Otherwise, we would otherwise have to issue that asset. And so, the Fed being at the very top of the global capital structure in a scenario where we're all rotating out of the bond market because we want to go from, here's another key takeaway from this discussion. We're going to go from 60-40 to, at the bare minimum, 60-30-10, with the 10 being alternatives like Bitcoin, hedge funds, commodity trading advisors, folks like myself. We'll launch an ETF at some point. That 10 is going to be, we don't need as many bonds anymore.
Yes,
and
yeah,
so
for sure.
The government is going to respond, in our opinion, to the exodus from 40 to 10, the 60-30, 60-40, 60-30-10. When they respond, it means that we in the private sector no longer will be tasked with the responsibility of capitalizing the U.S. government, of giving the government our savings so that they can build bridges and roads and spend money on healthcare. That means the insurance companies might have to do it. The banks might have to do it. Somebody else might have to do it, as opposed to me and you, who are then now freed of that capital to go buy more Bitcoin. We're going to go from 60-40 to 60-30-10. You might be 60-25-15 by the end of this decade.
So it's more capital not going into the bond market. Is it also a potential for the government to expand their balance sheet and just kind of like buy their own bonds? Like, that seems to be the response from England and Japan, right? They're just printing money and buying it, right?
Yeah, so some people seem to have that view. I don't share that view. I don't think it's politically palatable in a high inflation regime here in the U.S. because don't forget the Fed, prior to 2021, late 2020, 2021, the Fed was kind of villainized for all the quantitative easing and all the financial, all the sort of the wealth inequality that it's perpetuated. I mean, if you look at, we track, various measures of wealth inequality and income inequality, and they're about as for most measures, they're about as records, most records. I mean, unless at the bare minimum, you got to go back to like late 1920s to see this kind of level of wealth and income inequality in the U.S. And we all know how that turned out. And so it's my belief that the government is going to have to be more stealth about how it gets its money from us, or not gets its money from us, gets its money. In a disinflationary world, the Fed can just flex its balance sheet and buy as many treasuries as it wants, and and it's all hunky dory. And the reason the stock market goes up is because instead of us having to buy the damn treasuries, we're still left with money. We got to go further on the risk curve. And every time you go further on the risk curves, the asset you bought from the guy who was already there or gal needs to go buy a new riskier asset. And that's how the whole quantitative easing process works. Quantitative tightening works in reverse. I don't think they're going to be able to. There might be different programs to supply the market with various liquidity measures and stuff like the Bank of England does. But this concept of like QE, just balance sheet expansion, let me gobble up treasuries, I don't think we're going there anymore. I think they're going to have to be a lot more stealth with it, which is why things like yield curve control that comes into play. Things like again, I think regulatory policy will come into play. You might see right now, foreign institutions are selling dollars and trying to buy their currencies to support their currencies. Right now, you might see that reverse as well, in the sense that they're buying dollars. You might have a big sort of dollar bear market. That's on the other side of this, on the side of whatever economic recovery that we're going to see. And so there'll be ways for the government to get its money that'll be sort of less, less contributory to income and wealth inequality in this decade.
Well, it's fascinating. I think I could continue this conversation forever. For anyone who wants to check out, Darius does some of the best research in this entire macro space. Could you tell the audience how to find your research and how to stay up to date? Because I've been, my research team subscribes to 42 Macro, and we use your research all the time in informing our opinion. I did a video the other day sort of saying, hey, everyone, it's been really bearish. I've been making a lot of bearish content. Like, I don't want to seem like I'm fear mongering. Are you guys getting value out of this? And all the comments were like, this is amazing, so thank you. And so if you guys want to know what one of my primary sources is, it's Darius. So please tell the audience how they can get a hold of more of your research.
Well, I really appreciate that, man. Thank you, man. And so obviously we're 42macro.com. I'm on Twitter at 42macrodale. The one thing I will say, just leave the kind of audience with this. There is a really cavernous difference. So I spent my career in institutional finance, kind of left to start my own firm a couple of years ago. There's a big difference between macro risk management and macro. And I think when you log on to crypto Twitter or finance Twitter, there's just a lot of charts being thrown around, and some of them are smart, some of them are entertaining, some of them are intellectual, and they help you and they inform you, and that's macro. Macro risk management is the respect of the x-axis for all of this. It's the when do I put on a trade? How do I put on a trade? What's the distribution of probable economic and market outcomes? How am I positioning for the distribution of probable economic outcomes? How are those things changing? So that's what we do at 42 Macro, is try to help inform ourselves first and foremost. When I put that presentation together, I'm trying to make myself smarter, and then we sell it to everybody else to make them smarter. We've taken that, we distill all that information into actionable portfolio construction guidance. Here's how you should be allocated across factors. Here's how that should change this week relative to last week, this month relative to last month. It's a very systematic overlay to kind of condensing a lot of the information that we're all inundated with on a regular basis. Now, I'm really good at inundating people with information. You've seen me. You're on the.
I feel it. I can feel it right now.
But we're also very good at synthesizing it all in terms of helping investors actually make money from that. Because at the end of the day, that's what we're here to do, is to make and save money. So check us out at 42 Macro.
Yeah, thank you so much. Thank you for taking the time to be on the channel. Everyone, go check out Darius. His Twitter's linked in the description below, and we hope to have you back on the channel very soon.
Always, man. Appreciate you, bro. Thanks again for the kind words. You're a good dude.
All right, once again, if you enjoyed that, make sure you go follow Darius. The link is in the description. If you got some value out of this video, please smash that like button. It takes 2 seconds. It really shows YouTube and this channel that you enjoyed the video. As always, make sure you subscribe. We'll have more videos coming up very soon, helping you understand what the heck is going on out there and how, of course, Bitcoin and our beloved cryptocurrency fits into this whole insane mess. As always, I'm EllioTrades. I thank you so much for watching, and I'll see you very soon on the next episode.